Okay, good afternoon, ladies and gentlemen. Very warm welcome to this week's weekly market review for July the 3rd. I am Benjamin Goh, the head of research and investor education here at SIAS. With me is our senior technical analyst, Sunny. So, working from home today with my dual screen. So if I don't, look at the camera, rest assured I'm doing something related to this weekly market review. All right. The disclaimer is that, again, as you know, SIAS is a registered charity. We are not licensed by MES. So whatever that we talk about today, especially for specific stocks and companies, cannot be misconstrued as a recommendation. So do see a licensed financial professional before taking any kind of action in the capital markets. All right. Want to kind of, before we get there, a couple of announcements. The next RCR session is on Wednesday, 7 p.m., July 19. You can use the QR code to chope your seat. This is, again, exclusive for members. So if you're not a member, you might want to consider signing up. Again, we are using Google for review. So if you could do us a big favor, if you like us, please give us a 5-star rating using the QR code. That'd be very helpful for us to determine what kind of programs we should put out there now. And speaking of the membership, is going for $1 per month, $12 per year actually. And I think the main benefit is to be able to join us for the monthly RCR session. This is where you can ask any kind of question that you want, and Sunny and myself will try to answer it on the spot. All right. Okay, now let's get going. Wanted to kind of touch base on the disconnect between the what's happening in the stock prices versus the real economy. So the whole conundrum is that again, there seems to be the next leg of the bull run, at least on the US side, in the stock prices, and whether or not that is actually supported by economic indicators or changes in the real economy. So the problem in the beginning was that the stock market seems to be running far ahead in front of any significant improvements in the real economy. Now, one piece of news or study which came out, which I thought was quite interesting, was that Bloomberg Intelligence ran a economic model of the US economy. Basically uses, for those of you who are technically inclined, what you call logistic regression, which is, by the way, nowadays classified as part of machine learning. Logistic regression to try to figure out whether the economy is doing well or not well. And what they do is that they will put in information on a month-to-month changes in a couple of key economic indicators. So we're looking at capacity utilization, continuing jobless claims, the manufacturing ISM index, as well as the University of Michigan consumer sentiment. So I just want to touch base on a little bit on the capacity utilization. So the idea here is that capacity utilization is between 0 to 100%, all right? So if it's 100%, that means you're using 100% of your company's infrastructure, like your machines and all that. If you're using 0%, that means nobody is working. So generally speaking, for an economy that's humming along, you want to see a capacity utilization which is quite close to 100%. Now, you'll never be 100% or more than 100% for a very long time, because even if you're running 3 shifts, so on and so forth, there'll always be some downtime because you need to do repair and maintenance. And obviously, if you look at the COVID years, the capacity utilization was relatively low because companies had to shut down. Okay, so that's the explanation for capacity utilization. Okay, not going to go into the specific readings for each of these indicators, but suffice it to say, this Bloomberg's logistic regression model enables them to create an index value between 0 to 1. Again, this is a function of logistic regression. It's always 0 to 1, with 0 meaning that there's a recession. Now, the readings I'm going to take out here is a couple of bullet points, pivotal moments in the last few months. Now, more than a year ago, or rather a year ago, in June 2022, the reading from this model was 0.7. So remember, between 0 and 1, so 0.7 is kind of like the high point, and Generally 0.7, 0.8 for this model means normal economy. So December 2022, you can see the reading went all the way down to 0.02, which is very close to zero, right? So from this particular angle, it does suggest that the recession in the US started at the end of last year. So it's not as if it's happening now. It's been the economic indicators have not been great for a long time already, last 6 months or 7 months. Now the reading is, as of today, is 0.35, which is obviously not even half of 0.8, which is kind of the normal. But it does suggest a huge improvement from 6 months ago in December 2022. Okay, so at least from this model's perspective, things are not normal, but things have improved from the low point. Which suggests the economy is the real economy, right? Is healing, right? I mean that we have passed the worst part, which was December last year. Now this is the actual chart based on the logistics regression. So as you can see, the 0.35, and let me see whether I can get this out. The 0.35 is right over here. Okay. So the low point was reached back in December last year. As you can see, based on historical norms, historical evidence, whenever this Bloomberg economic model is quite a low number, that actually coincides with later on the economists will state that that's the period where there was recession. So in this way, there is at least some comfort level that this model tends to work. All right. So even for the recession, the COVID recession in the year 2020, after 6 months or so, the economists actually say that yes, that was the recession point. So now we are here. Okay, so we do have a rapid improvement in the economic model, which is kind of the typical response in all previous recessions in the US. Actually not so typical because see, this one, it seems to be a straight up improvement, but at least we're getting there. Now if you look at the 6 months average or moving average of this index over here, we are 0.3. So using a moving average tends to smooth out the volatile movements, but again, as you can see, there is it's quite clearly that it's on the mend. All right. So this has been something that I was wrestling with for the last few weeks as to, how come the stock market seems to be accelerating, going up and up, while the real economy seems to be stuck. But now we have got new tools that we can look at. The other thing is, and before I move on to the next slide, the other thing is that, again, over the weekend, there was a analysis done, again by Bloomberg, that suggested that the advance in the US stock market is now broadening away from the top 5 tech companies. So even the small caps, some of the small caps are already moving. That is fantastic news because it supports the narrative that the advance is broad-based and and the support is more deep-rooted rather than just coalescing around the top 5 biggest companies on S&P 500. So that's actually great news. I think going forward, I'm leaning towards more of a buy call, although we don't do recommendations. All right, so this could be I guess not the low point of the market. Obviously the market has already ran quite a fair bit, but I like the fact that the some of the market indicators and models out there are supporting the advance in the stock market. So at least there's some signs to the madness. Now, this is again a study on the historical average performance of the S&P 500 after major recessions, except for the recession that was happened in 1981. All other recessions in the US, as you can see, whether it's 3 months after the recession was called, or 3 months after the recession ended, or 6 months, or 1 year after that, the stock market tended to do quite well. From this particular chart, I want to kind of give a little bit of a caveat, because the stock market, obviously, in this particular case, has already ran quite a fair bit. I think it was already 16% up or something. So which means that it's already kind of fulfilled the typical 20%-ish 1 year forward advance in the stock market after the end of a recession. So it does look like the recovery in the stock market is running ahead of its historical norms. All right. So that's something to be aware of. Back to a couple of risk factors that I want to point out particularly for this model. The capacity utilization is a big deal, so it has declined from its peak over here. So as you can see, this is basically the COVID years. The what you call the the capacity utilization crashed quite a fair bit. Now is at its peak. It has come down a little bit, but it seems to be stabilizing. If you look at a simple trend line, it seems to be uptrend. Again, you cannot be 100%. So as you can see on the left-hand side of y-axis, now it's currently at 80%, which is quite a nice number. The ISM manufacturing and consumer sentiment indices, this would be the white line as well as the what's this orange line. These are far below their 5-year average. They are 1.1 and 1.8 standard deviations below the 5-year average. So which means that this is not normal. We want to see it closer to the 5-year average. But I think the silver lining here is that means it's probably going to go up rather than go down. So which means that manufacturing sentiment as well as consumer sentiment should improve going forward in the next few quarters, which again supports the narrative that economic situation conditions in the US are improving. So what's quite nice is that again the continuing jobless claims, as you can see, was a vast improvement from the COVID recession. It has gone up a little bit during the March-May period of this year, but it seems to be coming down in the latest reading. So again, from a historical norm, as you can see, is not dramatically different from the pre-COVID days. So again, that's a pretty nice narrative, which I kind of like. All right. All right. So so the net is that I think the economic situation in the US is vast improvement from just a couple of months ago, and perhaps it's time to take a dip in the water. As for the timing, I think Sunny would be a better person to comment on that. But at least from a narrative perspective, I think it's time to go back in the water.
Yes, and from what I hear with what Benjamin has shared earlier, it seems to be tying in with the data that that's been published recently. So I'll go through the economic data first. Again, this show that we run here, although it's a pre-recording, Ben and myself, we don't do any rehearsal. So I do not know what Ben is going to be presenting. I don't know what his viewpoint, but it seems that what he's saying today seems to be tying in with the data that is coming out, or what we are going to see. Okay, so this week, today's Monday, so we are expecting the ISM manufacturing PMI data to be coming out. Previous reading at 46.9. Consensus says that it will be slightly better at 47, so a 0.1 point improvement. So if that is the case, then definitely it's a positive for the market again that says that the economy is recovering, the economy is doing well, which is what Ben is saying earlier on just now. Then after that, on Thursday, we have the details of the FOMC minutes. The script will be published, so any details will be inside there. Investors will be trying to read between those lines of that report and see if they can dig out any other further information of what Fed is thinking about the economy or inflation or even the rate hike details. Then after that, we have the ISM service PMI data for the month of June on Thursday as well at 10 p.m. So it is above 50 points. So anything above 50 in the PMI index is always reading as an expansion. So that is on the service side, is doing okay in the US. And of course, on Friday, that's the big data here, the non-farm payroll data, NFP for June. The previous data that we have was 339K, which is a wonderful number. But the consensus for this round, for this month, is 225K. Now, just to take note, non-farm payroll is actually a very volatile kind of a data, because historically, it has shown that the numbers can fluctuate, and the actual data can be very far away from the consensus, and normally there are revisions going along with every month of the data that's being published. So my opinion is, so Ben just now said earlier that maybe it's the time to dip your toes into the market right now. But my opinion is we have the first half of the data published already. 30th of June last week was actually the last trading day of the first half of this year. So my opinion now going forward is the economic data, especially the ISM, the PMI data, the non-farm payroll data, has been improving along. So this signifies to us that the economy is actually in a very healthy state. So with the economy in a very healthy state, then definitely inflation will continue to become pretty stubborn. And that if the non-farm payroll data and the PMI data is improving, then it further justifies the Fed to raise interest rate further, even more than the 2 that was projected in the dot plot chart, which we will touch on later on. Okay, so these are the important data. So the big data, of course, will be on Friday, the non-farm payroll data, 339,000, the previous month number in May, and consensus 225. Unemployment rate is still pretty stable, 3.7%. Is likely going to be the same figure for this month as well. So not a lot of big changes on the unemployment number. The details will be in the non-farm payroll data that will be coming out this week. So on the Asia, the Chinese side, we just have the China PMI data for June coming out also. It's just published a few minutes ago. I saw it flash on my screen just now. So the actual number is 50.5, previous number of 50.9. So a bit of a pullback, however, still above consensus and still above the 50-point mark. So it's still expanding, but although at a very slow pace for China economy. So this is the reading of the China economy right now, according to the China Caixin PMI index. Okay, so let's next move to the CME Fed Watch tool. The calculating the probabilities of the rate hike, going point hike to bring the interest rate to 5.5% was at the probability of 71.92%. Fast forward 1 week to today, we have seen that the probability increased to 87.42. So I can see that 25 basis point hike would likely have been baked into the market right now. And having said that, we also saw the 3 major US indices logging in close to a 1% hike last Friday. So that would mean that even with the 25 basis point hike, investors are still very confident with the economy going into the second half of this year. Okay, so let's do a recap of the dot plot chart also. So this is the dot plot chart over here. Okay, so the previous dot plot chart that we have was that the consensus of the peak rate was around the 5.1%. And then after that, last month meeting, we have the updated dot plot chart that most of the FOMC members, participants, they say that likely we are going to see the peak interest rate hover around the 5.5 or 5.75%, which is where the blue color dots are over here. So that's why that is my opinion also, that if let's say economy continues to perform well and looking at the data is coming out, we may there are talks of analysts saying that we may not see a recession this year in the US, or maybe a very light one. So I think that's in line with what the data is trying to tell us. So I do not sort of a rule out that even in further dot plot chart updates, we might see the peak interest rate go higher also if the economy continues to perform as it has been performing in the first 6 months of this year. So I'm going to place less emphasis on what the Fed is going to say. I'm going to place less emphasis on where the peak rate is going to be. I'm going to place more emphasis on the non-farm payroll data and the PMI data to ensure that they continue to stay healthy, and thereby that will further justify us of starting to dip our toes into the market again to start to accumulate on the long side. Okay, so I just want to do some weekly updates on the STI index stocks to see where are the big gainers. So I have sorted this stock screener, okay, according to the weekly performance. You can see that the top 3 weekly performance for last week is Yangtze Shipbuilding, which was up 16% for the 5 trading days. The next one is Sembcorp Industry, was 5.37%. And of course, the next one we have here is the Fraser Logistics and Commercial Trust, up 3.28%. So these are the top 3 winners or the top 3 percentage gainers for the whole of last week. Okay, so I've covered the Yangtze Shipbuilding and Sembcorp Industry in our weekly technical insights. So do look out for that video when it's published later on. So if you can see over here, the monthly performance of the Yangtze Shipbuilding stocks is actually gaining, like on a monthly performance calculation, is up 21%, 3 months it's up 23%. So pretty healthy growth over here. So if this strong uptrend is actually going to continue, then after that, where should we be getting in? So do look out for the technical insights video. Same thing for Sembcorp Industry. Monthly is up 13%, 3 months is up 29%, 6 months is up 65%. Now, who says that the Singapore market is not exciting at all? These kind of gains are pretty mouth-watering. Okay, so let's go to the index right now. So just a recap of the Dow Jones Index, we closed last Friday up 0.84% or 285 points, which is a very strong gain. So that explains the gap up that you see over here. However, this gap up, as you can see, is sort of testing the double top or even a triple top that around the level of 34,281, which we have been calling out for quite a few times already on the weekly market review. So this is a resistance to watch. We have seen a gap up. So I am at this moment, I'm not very sure if this resistance level is likely to hold on because of the gap up. If let's say we have a retracement or a back down and then retest this level again and it continues to hold, then this double top become a resistance and support level going forward for the Dow Jones Index. Okay, but according to the indicators right now, we can see that the MACD indicator, the MACD line and the signal line is pretty close together. It seems like a parallel kind of a formation forming. So it's likely going to be, what it's telling us is going to be range bound, or there may not be any clear direction right now for the Dow Jones Index, waiting for more catalysts, I think likely coming out from the non-farm payroll data that we are going to see this week. On the RSI index, the reading at 62.56 is pretty healthy, 10 points above the 50-point neutral mark, 10 points away from the 70-point overbought signal. So this is showing us that there's healthy momentum in the Dow Jones Index right now. So with MACD pretty much in a neutral state and RSI telling us that there might be some kind of a positive momentum still embedded in Dow Jones Index. The thing is we should not go and short the Dow Jones Index right now, but rather look for a pullback to get back into the Dow Jones Index, which comes at the 20 days moving average around the 33,900 level, or even the lower bound of the Bollinger Band, 33,333. Okay, next let's look at the S&P 500. Okay, so this is the S&P 500. Now, the S&P 500 form a sort of a pretty critical kind of a chart formation. It seems like a double top formation is forming up on the S&P 500. That signals to us that this is the resistance level to watch out for. If we don't have a break above this double top formation, and if we have a pullback towards the 20 days moving average at 4,351, then this double top formation will be the near-term resistance for the S&P 500 level. Why do I say so? Because if you look at the MACD indicator, MACD histogram has been negative for the past 5 trading days already, and we can see that the MACD line is trending below the signal line, so that means that there's negative momentum in the S&P 500 index right now. On the RSI, the latest reading last Friday at 69.21 is actually just 1 point or even less than 1 point away from the 70-point overbought mark. So that means that we are entering into a overbought territory, and it also tells us that a pullback is likely going to happen whenever the RSI crosses above the 70-point mark. So for S&P 500, I'm more skeptical that the rally will push forward. I believe that some profit taking might happen in the near term. So I would believe that the S&P 500 is likely going to pull back, and the pullback we also definitely will be looking at the 20 days moving average, which is on the Bollinger Band basis at 4,351 points. So that is the first sign that we want to take note or get our heads up and see if the 20 days moving average is going to hold, because it is a very strong uptrend. The candlestick or the prices or the index point usually trend above the 20 days moving average. If that fails, then definitely the lower bound of the Bollinger Band will come in to provide further support at 4,221. So you can see that this 4,200 level might be a safer level in case a pullback of the S&P 500 happens and you want to get back in on the uptrend. This is the low bound of the Bollinger Band would be a more sort of conservative entry point, which also coincides with the double top or even a triple top formation for the first half of this year, as you can see on the S&P 500 index. So this resistance level now, I would say that it may have because we have a convincing breakthrough above this level. So this resistance level, which is a key level, might have a change in polarity to become a support level. So 4,195, 4,200 key support level for S&P 500 for the rally in the first half of this year to sustain going forward into the second half. On the Nasdaq Composite Index, which is driving the rally, the AI rally that we have seen in the first half of this year, we can see that last Friday closing at 13,781, we are up 1.45%. So this is the best performance among the 3 index. No surprises there. It's up almost 200 points, 196 points for last Friday. So also a gap up. But however, we are testing the year-to-date high, which happened on the 16th of June. That is at the level of 13,864. So we are about 100 points away from that year-to-date high. Again, if you look at the indicators, MACD is starting to trend down already. MACD line has crossed below the signal line, further indicating to us that a pullback is likely going to happen. Momentum is weakening and likely going to go negative. The RSI is 4 points away from the 70-point overbought mark. So if it crosses above that, then definitely it will be another signal that we have gone into a overbought territory, and then a pullback is likely going to happen. So I think Nasdaq Composite Index, you might want to consider taking some profit off the table if you have vested interest in the Nasdaq Composite Index or any of the AI stocks that you have traded in recently. So wait for a pullback. I believe 20 days moving average will be a very healthy level to start looking at the Nasdaq Composite Index to go long, 13,481 with the lower bound of that Bollinger Band at 12,988. So 13,000, the handle of 13,000 would likely provide a strong support for the Nasdaq Composite Index. Next, let's move to the Hang Seng Index. I think Hang Seng Index is pretty muted for the past 1 week, as you can see over here, trading within a very tight kind of a range bound for the last 5 trading days for the whole of last week. So reiterating that I do have a position on the HSI index, and I got in on the low of the March period this year, which is around the 18,800 level. So we have a pullback towards the 18,200 level somewhere in the May period, and then after we have a pretty strong recovery. Now we are at this level again. I believe this level between the 18,800 and the 18,200 is likely going to be the low for the Hang Seng Index for this year. And we are waiting for more catalysts on 2 fronts. One is from the stimulus from the Chinese government, as well as the AI wave pouring into the Asian side as well. So you can see that the ChatGPT kind of craze has been quite prominent in the US index, the US indices. If let's say the Tencent, the Alibaba with their developments, if they're going to come up with their own AI software or platform, then definitely it will be a catalyst for the Hang Seng Index as well as the Hang Seng Tech Index as well. So these are the few catalysts that I'm looking at, although I just want to let you know that the property market is still not doing very well in the Chinese or the North Asia side. So any stimulus that's come from the government might be able to sort of subside those worries. Okay, so next, let's move to the STI Index. Now, STI Index has been in a converging kind of a triangle formation, and we are going into the tail end of that converging triangle. I have a quick look at the MACD indicator as well as the RSI. You can see MACD indicator is literally parallel to the zero baseline, and the RSI indicator is at 46.83, just 4 points below the 50-point neutral mark, which means that it is either slightly weak or going into a neutral kind of a reading for both the MACD and the RSI indicator. So that means that the Straits Times Index now is pretty much directionless, I would say, in the near term. We are waiting for further catalysts to come in, and we might take the lead from the US with the non-farm payroll data this Friday. So key levels to watch out for the STI Index. We have a sort of a high point over here on the 16th of June that's around the 3,261 point level, which is the upper bound of the Bollinger Band as well. And then on the support side, the lower bound of the Bollinger Band is reading at 3,153 with the year-to-date low around the 3,094 points level. So 3,100 to 3,150 points would be the key support level to watch out for the STI Index. Resistance level, we are looking at the high in April, which is the 3,313 points level. And if let's say we have a sort of a positive data coming out from the US this week on Friday on the non-farm data, then definitely the range that we'll be looking at for the index between the 3,300 and the last year in December period might reflect over here going forward for the next, at least for the month of July, I see if we have a positive non-farm payroll data. Okay, so that's all I have for the updates on the index today. Anything else to add, Benjamin?
No. Sorry, bad throat. No, not really. Thank you so much for that. That provides a lot of clarity, especially the support levels. Interesting is that the beginning of the year in January, right? The consensus estimate for year-end S&P 500 target was 4,100. Now we are below that, and 4,195 or 4,200 is the support. Wow, it's like. The world has changed. Okay, so thank you very much for that. So we're gonna end our show today. Thank you very much for joining us, and we will see you next week.